Are you a dentist looking to build wealth, maybe create passive income, and be able to eventually step away from the chair? Are there things that you feel like you should or could be doing, but you just don't know where to start? Hi, I'm Jonathan Moffat, a wealth strategist who's built and sold an 8-practice DSO. Now, I help dentists align their practice success with their personal financial freedom. Each week on this podcast, you'll discover strategies to boost your practice profitability, multiply your wealth, and transform your dental career into the lifestyle you've always dreamed of. This is Dental Wealth Multiplier. Hi, and welcome to another episode of Dental Wealth Multiplier podcast. And I've got with me a great guest, not the first time you've been on the podcast, Craig Leone from Huntington Bank. Craig, great to see you again. Great to have you on here again.
Yeah, thanks for having me, Jonathan. Appreciate it.
Yeah, of course. Excited to have you guys back with us in September for our event. And but I kind of one of the things that I'd love to kind of just dig into is from the bank's perspective, and you've been in banking. You can maybe give us a brief little background history of yourself as far as like your experience in dental, both in banking and in the dental side. Maybe give us a little bit of that background on you, and then let's jump into a couple of topics I think are really relevant for a lot of the people listening.
Sure, absolutely. Well, I actually got my start in the military, so I served 11 years. Was an infantry soldier, then an officer, and I gained a lot of accountancy experience there, which really, allowed me to take off once I hit the ground floor in banking. So I do have a private banking background as well. So I did my first 5 years in the private bank, and then went to Huntington, and I've been in practice finance for a little over 5 years now. So I actually served on the underwriting side, and I was an underwriting manager before coming into my role now. Really, what all that means is, I might have a little bit more attention to detail. I'm a little more analytical, and I'm really able to partner with doctors throughout their growth journey.
Awesome. Thanks. I had forgotten that you'd served in the military, and thank you for your service. And yeah, I appreciate you bringing that up. So what's changed like throughout your career, as you've kind of seen, like when you first started? Like, I remember when I first started, got started working with dentists. It was like if you were a dental student, you graduate from dental school, and you essentially had a blank check from a bank to write to go start your practice, right? I mean, it literally was like, I remember it was like you needed a dental degree, and that was it. Like they would fund you right out of dental school, no experience, just how much you want us write the check, and where do you want us to send it, type of thing, right? Probably changed a little bit, right? Since 20 some odd years ago.
Yeah, no, I think it has, and I think there's specialized arms at banks that do practice finance day in and day out. Huntington has that as well. And I think on the credit side, every 4 or 5 years, they take a good hard look at loan losses and how the portfolio is doing. And at that time, you might see a little bit of contraction or expansion. We have actually seen some expansion from the way we look at, to touch on the point, coming directly out of school, we actually do fund doctors directly out of school if you went through a specialty residency. Now, a GP, we usually like to see 1 to 2 years of associate experience to gauge, clinical production ability and earnings, just to make sure everything's on track there.
Yeah, and what are you looking for? So interesting to know if you're doing a residency. I'll be speaking to some endodontist residents here in a few months, so I might have to get some talking points from you on there for them. But from the GP standpoint, what are you looking for specifically? Are you just like looking at, okay, send over your CV. Okay, looks like you graduated from dental school in 2012. It's 2015. You've got about 2.5 years or 3 years under your belt. That's all we really are looking for, or what else are you looking for those young kind of doctors doing those startups?
Yeah, so we have a lot of data. We have a lot of industry averages. For GP, what we really like to see is that you've attained $150,000 in earnings and right around $500,000 to $550,000 of production ability. Now, that could vary upon the different practices you're in, cash-based business, or if it's Medicare, Medicaid. That's why it's important not to only take a look at your historical tax returns, W-2s, 1099s, but also your production reports if you're able to obtain those. And for specialists, those numbers vary. really depending on the specialty. Endodontics is a very excellent specialty that we do here as well, that we provide funding right out of residency.
So, and just to kind of put it in maybe layman's, and this is maybe more for me than our listeners. When you say earnings, you're saying we want to see that you took home, you got a paycheck of at least $150,000 in that prior year, and you produced around 550,000. Is that right?
That's right.
Yeah. Okay. So take home 150, produce 550. What anything else you guys are looking at for that kind of first time practice? And are those metrics the same for an acquisition or a de novo startup? Are you look at the same metrics there?
No, that's the great questions. So I'll touch on the startup piece first. There's another variable in there, and that's how much you're requesting, right? So general GP startup, you're looking about $700,000 to $800,000. And sometimes we have clients that come in that are looking to do a larger project. Normally, we see a first office be between 3 and 5 chairs. Sometimes we have GPs or doctors who are really, really above industry average. They anticipate needing more than 3 or 4 chairs within the first 3 to 5 years of business. So they're looking for a space that could possibly accommodate maybe 8 chairs. And as you know, you have a higher leasehold expense. You have more equipment. You need maybe even more specialized equipment. And in those scenarios, we do look to see that they are above industry average earners. They're above industry average production. And that's how we really gauge the dollar amount there. Now, for an acquisition, we like to see that it's right size. Sometimes it just doesn't occur that way. And I'll give you an example. You might be an associate at a single doctor owner practice. So there's 2 practitioners in the practice, and you are essentially acquiring that business. Well, what that means is now we have 1 doctor owner who needs to cover down on clinical production ability for the entire practice. And we call that a gap. So there's a gap in production there because 1 owner is leaving. Usually that's not a problem. We look to see that they could at least handle 50% of that clinical production in the practice and really see how they're going to operate past that point. Are they going to hire an associate? Is the owner staying on for a period of time? Which is pretty typical there too.
Do you guys is that your preference? I mean, do you prefer that the owner sticks around for a period of time, or is that really not make that big of a difference for you guys when you're making that decision?
I think it is a positive. It's a good transfer of goodwill in the practice, and it leads to a little bit less of transition risk that credit sees in those scenarios. Sometimes it doesn't happen, and we'll weigh that based on the entire view of the transaction.
So, I mean, look, I think this is important not only for those listening who are maybe wanting to buy that first practice or do a startup, or their first startup, but also those who are thinking about selling or transitioning, right? You should start planning for that. And it's, again, interesting to know. And I would imagine, Craig, that the larger the practice, the larger the loan, the more important that probably is that doctor stick around and transition out, or at least make sure, if it's a 2 doctor run practice, that there's going to be a solution in there for how to keep it a 2 doctor run practice, right? I mean, imagine those are some of the things you guys are looking
for. Oh, absolutely. And if there's an associate in the practice already that's purchasing the practice, credit loves that. I mean, it reduces the transition risk that they see. But the majority of our transactions that we see, that doesn't occur. It's usually a single doctor that's associating elsewhere coming in and acquiring a practice. And again, that's fine. We do like to see that they're able to cover a good portion of that clinical production that's in the practice currently.
Now, what about, and I kind of I've got a bunch of questions, bunch of ground I want to cover here, because I think it's so important. I mean, look, we all need access. If you want to grow, if you want to start a business or grow and scale, I mean, again, the name of the podcast is Dental Wealth Multiplier, right? Like, how do we multiply our wealth? Well, one of the ways that you do that is by leverage, right? And sometimes that's leveraging the bank's money, and sometimes that's leveraging skills. We talk a lot about leveraging the team and the people and the resources we already have. But the reality is there's a really good chance you're going to need to borrow money, whether it's buying real estate or practices or additional practices. And so, how do those metrics change from a bank's perspective when you go from, okay, I've proven that I can either do a startup or an acquisition and I can grow a practice. I've proven that. Now I want to go to practice number two, right? I was at dinner last night with a GP, and his wife's an orthodontist. She had her first practice, done very well. He's like, we want to get to 5 practices, right? So now they're looking at like practice number 2. And so, what's the bank looking at when you get one of your repeat or your clients, your doctors coming to you and go, hey, look, I did a great job with practice number 1 that you guys gave me the money on. I'm ready for practice number 2. What are you guys looking for to make that an easy yes, or for both underwriting and credit? Say, yeah, let's do this.
Yeah, great question. Number one, the biggest hurdle is to look at that existing practice that the doctor's running. Is it stable? Do we see, at least an industry average EBITDA? Does it look like he or she is ready to move on to a second practice?
Sorry, Craig, not to interrupt you. What's the bank look at or consider to be an industry average EBITDA?
Well, it depends on the specialty. If we're talking a GP, right about 35%. Now, we do know that number goes down if you have an associate in the practice.
Right. That's an owner-operator. You own the practice. You're doing all of the dentistry, 35%. Right.
That's right.
Right. Okay. Perfect.
And that'll fluctuate. That might be location dependent, or if you are accepting Medicare, Medicaid, is it fee for service? So there's a lot of variables there, but that's just a benchmark that we.
If there's an associate in there, what if the production split? They do kind of 50-50 between 2 associates. What's that EBITDA? Or if it's all associate run, what's that EBITDA that the banks?
That could really vary. If an office fully run by associates that earn an industry average associate income, usually about 30% of production. We see those in the low to mid teens quite often. Now, if it's split 50-50, that'll probably be low to mid 20% range.
Okay. And that's where you're like, okay, these guys, and really what you're looking at, again, correct me if I'm wrong, is we've been fortunate to do a lot of our clients work with you guys, but really what you're looking at is, can the owner pay the bills of the practice, service the loan, and then pay for their own, support their lifestyle, right? And
Absolutely.
are there percentages that you want to see in terms of how much the doctor's taking home, or if you have a doctor's like, well, I take home 10%, you're like, well, we know that's not enough to live. What are there kind of general percentages that you're looking at in terms of those different debt service? And I would like to get into the weeds. Hopefully our listeners find this be interesting, because I'll let you answer that question first before we get into the weeds on ratios, because I do think that's a really interesting conversation that I'd love to have with you, that I don't think enough people talk about the importance of those ratios. So what does that look like in terms of are there percentages where it's this is how much we think you should allocate towards your living expense or personal kind of lifestyle expenses? So this is what we think you should have allocated toward debt service.
I think every situation is unique and different. Some folks like to run their business to the bottom line, meaning they kick out everything above a 1-to-1. So they pay their debts, and then they take distributions for everything else. And that's fine. What we do at Huntington is we look at the individual. First of all, we look globally. So we not only look at the business, but we do look personal. And when we look at personal, really high level calculation here, what we'll do is we'll see their debt service from a household perspective and multiply by 2. We call that a break even. So that number we replace as the officer compensation at the business level. And we allow all additional funds that they might have taken out of the practice to be added back to global debt service. So the funds that you have available to service any debt that you're requesting. Now that's important, because a lot of advice I give to newer doctors is you might love that $1 million property down the street, and that's a really great goal, but establish your practice first.
100%. Yes. Yeah. Preach the same thing. If you can delay that Porsche, right?
Right.
That $1 million, $2, $3 million house, the vacation home, especially if you're young. In fact, it's interesting. I don't know. I can't shut this off. It's always going. I think I was swimming laps or something the other day, and I literally stopped into a voice memo, and I was like, I'm gonna do this. I just literally like over the weekend, I was like, I want to actually do a run the numbers on if you delayed the the extra mortgage payment like of the bigger home versus what would suffice, or the bigger car payment versus whatever, and you invested that into your practice, what would that ROI end up being over 5, 10, 15, 20 years? Anyways, it's just,
Right.
like I said, I'm a dork. Literally can't shut this. I can't shut it off. I'm always thinking about this stuff. But it's such a good point, Craig. It's such a good point. It's like, put the money back into your practice. And we're going to get to liquidity. Like I said, I've got a list of things we're going to talk about here. But
Sure. Yeah.
But yeah, put it back into the practice and delay that vacation home or the bigger, like, until it's the right time, right? Sorry, go ahead. I know I cut you off. Sorry, go ahead.
Well, it's really hot on my mind now that we're talking about it. Another important point I like to make with newer doctors that are looking to own a practice is I know that student loan debt, I know that car payment, I know that the mortgage. I know that that's on your personal balance sheet. You might be really, really great at attacking that. But banks, not just Huntington, but a lot of banks, they would rather see a higher amount of liquid assets on your balance sheet when you go in to take out that first business loan. So
is there a number or a percentage? Like what do you because I bring this up and I'm glad you're talking about it, because we're seeing that becoming a bigger and bigger issue. We talked about this even 2 years
right.
ago. I talked about it. You and I did a podcast. We talked about it. I think I spoke at several different groups around this about this very thing. Like, liquidity is becoming a bigger issue than maybe it was 10, 15 years ago.
Yeah, and a lot of folks are really focusing in on that number. And just to give you a high level number, it's 10%. So if you want to take
10%
out,
of what you're requesting.
yep, if you want to take out $1 million, they're looking for right around $100,000 in liquid assets. That's checking, savings, brokerage. Unfortunately, that's not crypto, right? A lot of people don't. A lot of people have crypto.
Yeah.
And really the premise behind that is, you might have been associating for 2, 3, 4 years and earning really great earnings. You might be at about 200 a year, maybe more, but you're only showing $15,000, $20,000 on your personal balance sheet. So that usually brings up more questions than answers to the underwriting staff. So we like to try to avoid that and say, if you're fully focused on your business, hold off the expenses, build your liquidity, ensure that your business takes off, right?
Yeah.
And to have that backup liquidity is very important as well.
So checking, savings, brokerage, anything else fall in that category from the bank's perspective of what you'd consider liquid? Probably not 401k, IRA assets, because that's not really liquid, right?
Right. Exactly. Yeah.
Yeah. And again, I would just say, if you're listening to this and you're on the front end, build that habit now of saving. Unfortunately, I've seen far too many, Craig, I'm sure you have too, doctors who have been practicing for 20, 30 years who are in their late 50s, 60s, and you're like, great, what do you have for your emergency fund? They're like, nothing. How do you not? Nothing, right? And again, it's not that your dentistry is an amazing, amazing profession, and you have the opportunity to make a lot of money, right? But unfortunately, what we see a lot of times is that you make more money, the lifestyle increases, right? And then the kind we were talking about from before, right? So if you can have that discipline and that delayed gratification, it's going to free you up with the ability to grow your assets that actually appreciate in value and are going to actually generate income and even passive income to talk about, as opposed to some of those other assets that or I'm gonna call that, yeah, and or liabilities, right? That that don't do that, right? So I think it's a really good point, Craig, like the liquidity piece. So 10% of what you're requesting, make sure you've got it liquid. Make sure you can show, here it is on the balance sheet, not crypto. I love that. Any other thoughts on that before we shift gears?
Well, I know we were talking about what's important when you're looking to expand.
Yeah.
And we touched on startups, but if you own a practice, I did want to touch on this point. If you do own a practice, what we do look for, number one, is that that practice is stable and doing well. Now, there's two different options at that point when you're expanding, either de novo or you're acquiring a second practice. Now, acquiring a second practice, banks are able to look at those two combined. So they're looking at a global analysis. They want to make sure that that first practice, that flagship practice, is self-stabilizing and self-sufficient. And then they look at and consider the revenues and the cash flow of that practice that you're looking to purchase. Now, de novo is a little bit more unique because now that your flagship practice has to be able to not only support its current operations and debt service, but also that of your second location. So just keeping that in mind, all of that debt service is now serviced only by your flagship location. So it could potentially get a little tighter, but we have folks that do it all the time.
And how important is it on the buying side, if you're doing an acquisition, to like, what are you guys looking at as far as is there again a ratio or a percentage of purchase price of that second practice or third location in terms of like a percentage of revenue? Often we hear like, oh, it's 80% of revenue, or right? Is that like, what are you guys looking at as far as like, oh, hey, we think you're actually overpaying for this practice, therefore it's not cash flowing, or yeah, it looks like this is a smart buy, you're getting it at the right, at a good price for the profitability and for the cash
No, you hit the nail on the head saying profitability and cash flow. I mean, that's a major component here. Also, location is a major component, right? Rural Kansas is different than, Richmond, Virginia. It's just that could be a very big differentiator, but we do see right around 75-80% is, I would say, is a pretty good average for sale price. Now, what we see a lot of times too is that the profitability of the practice decreases in some instances. It could be aging owners that no longer do specialty procedures and refer them out, which at that point you're going to see a much higher hygiene or maybe even cosmetic percentage of procedures. And sometimes those practices, they don't hit 75 or 80%. They might be around 50 or 60%.
Yeah.
But really, there's so many factors that pertain to that. It's very unique. It's really situation dependent.
Along that line too, on the acquisition side, you're again just some other, I think, ideas to kind of be thinking about. You kind of touched on it, Craig. Is number one, if you have a practice, you've been the sole practitioner there, and you've grown it, and you want to go buy practice number two. I'm imagining from the bank perspective, you're going to want to see, okay, what's your plan now that you have two practices? Who's going to be working in that? What if the associate or the doctor in practice number two doesn't show up? Who's going to be right? Like, you want to see a little bit of thought process through how they're going to be able to maintain both locations, right? And I think there's a comment, we hear it more and more, which is that money's gotten smarter, right? Again, I think 10, 15 years ago, banks would be, hey, I'm going to get practice number 2 or 3. Like, yep, here's the check, looks great, right? And now what they're realizing is, okay, it's actually really hard to run 2 practices. 3 practices, actually, I think the hardest. 2 practices is pretty manageable. 3 is where we start to see like, ooh, this is getting kind of tough, right? Even to the point where it's like, I don't know that I can manage this, and right. So again, when someone's coming to you, Craig, and saying, hey, I'm ready to buy practice number 2, number 3, you're looking at, great, from a personal perspective, are you liquid? Do you have that liquidity? 10% of what you're requesting of this new purchase price, maybe even a little more because you've got 1 or 2 practices. From a practice standpoint, is the practice profitable? But how important is it having or does it even matter having some sort of a write-up or kind of an explanation of like, hey, here's how I plan to run practice number 2. I know I can't be at 2 places at once. I've got my brother or I've hired an associate or whatever. How important is that when you're considering, funding a second or third or additional future growth location?
A transition plan I think is very important. It not only communicates your plan to the bank, but also lets us know that you put some thought and some detail into that. And of course, everybody's going to put some thought into how they're going to operate 2 or 3 practices. But I'm working with a client of yours right now who they have 2 doctors, and they're going to split time between the practices. Just having any additional information like that is very very good to communicate to our underwriting staff, because in the background, in the basement where these folks work, they're writing up usually a 15 to 20-page document about your transaction, and that is a major piece of it. Is how are you going to operate successfully, not only that new practice, but your current. A lot of times we assume associate, but it's great to hear that from the owner.
Awesome. That's really helpful. I want to get into, and hopefully this doesn't, I want to go too far in the weeds, but again, I brought it up earlier. I want to circle back around because I think it's important to understand what covenants you're making with the bank, right? A lot of people, I think there's this idea, I remember when we owned our practices, it was like, you make your loan payments on time every month, you're good, right? And then you get the call and you're like, hey, we need to have a conversation because there's a problem, right? You guys aren't within covenants. And we're seeing this happening more and more. Now, I can draw my own conclusions as to why I think that's the case. I think, I'm not saying every bank's like this, but I do think, and we have a few clients where we're like, I think these banks are trying to get these low interest rate loans off their books, right? And then again, I'm totally speculating here, but the point is you want to be aware of what you're agreeing to other than just making on time, timely payments, right? Because a lot of people may not be aware that you're actually agreeing to meeting certain covenants that are ratios of like debt to EBITDA ratios or debt to income ratios. And I think, and maybe Craig, you can talk to a little bit around like what's Huntington's approach to those ratios? What are we seeing as kind of standard ratios? So I'm gonna hit you with like 3 questions here. What are we seeing as standard ratios? What should a red flag go up for you as a borrower of like, ooh, this seems like a little bit maybe not, like, I don't know that I'll be this, like this, I may be getting set up for failure here, right? Maybe there's like, oh, we see that if the ratio is above this or below, like maybe go get a second opinion, right? Again, as a bar, and then how important is that as like borrowing on like a single location, or like is that really something you need to be more concerned with when you're at like locations 4, 5, or 6 and above? When you reach a certain debt limit with the exposure with the bank, right? Oh, over $4 million, yeah, that's going to be a big issue. But again, I apologize, I hit you with like 5 different questions.
Oh, please. And I think that's a great question. What I love telling doctors is ask questions, ask clarifying questions, dig into those because it's important. So I'll talk from Huntington's perspective. Every bank's different. We have dollar thresholds, so we don't have financial reporting covenants. We don't have debt service coverage covenants until you hit $1 million in exposure. So if you're under that, we do have a team that'll work with you. It's actually very big benefit to new practice owners. It's called Practice Pulse. So we have a staff here that'll work with you on a monthly basis, could answer any of your questions. It's almost like a coaching staff that have actually worked in practices, but they'll compare you to industry averages. And, some people might think, well, that's, big brother looking over shoulder. But, if I was a practice owner, I would love to see how I'm comparing to the industry. Do I need to make any changes? Do I need to get credentialed with some other insurance companies? And, these folks are really good at what they do and help support new practice owners. But getting back to the point, so once you jump over that $1 million mark, you're, at Huntington and most other banks, what you're going to start seeing is financial reporting covenants and debt service coverage. Generally, it's annual. So they're going to ask you for annual tax return, profit and loss statements, personal financial statements. And that they're going to run a calculation in the back end, right? So there's going to be a staff at the bank who does a quick calculation to see if you're hitting that mark of debt service coverage. And generally, it's 1.1 times. Okay, so that is not a trigger to call default. That is a trigger to maybe ask some additional questions and work with the doctor just to make sure everything's okay. And that's what we do here.
And so, Craig, you said 1.1 times. Can we put some numbers to that just again for our listeners? So that's saying if you borrow $1 million, you're going to want to see $1.1 million in gross income. Is that what you're saying?
So that'll actually be from a debt service perspective. So let's say your loan payments add up to $100,000 a year. We're going to want to see your ending cash flow on a global basis be about $110,000. Just rough numbers.
All right. And then as far as like financial reporting, and again, there's reviewed financials, there's audited financials, there's maybe walk us through like what are those different sets of financial requirements, and again, what are those kind of like at 1 million we want this, at 3.5 million in exposure we're going to want this, at 7 million in exposure, whatever those, that's when you're going to kind of step up to this bigger audited financials or reviewed financials. Maybe talk a little bit about that.
No, great question. Really, I haven't seen it since I've been here that we require compile or CPA audited statements. I would say if you ever saw CPA audited as a requirement, throw up a red flag, have a discussion. That costs you money.
Oh, right? It's very expensive. Yeah, I mean to the tune of $10, $15 plus $1,000. I mean, depending on, there's reviewed and audited. I think audited is even more, like $20,000, $25,000.
Right. Yeah. So that could be significant. We require company prepared. We require that up to 5 million. Over 5 million, we still might require that. Sometimes we ask for compile. It really just depends on the ratio of lending and how the relationship looks at the time. But it's not a bait and switch. So whatever's in your commitment letter and your loan documents, that's what we go with. And any bank that tries to flip that is wrong. So it should always put up a red flag. Yeah,
and this is where again I would give a, just kind of make sure you're working with an accountant, with a bookkeeper, who understands these, right? I was just having this conversation with a client the other day around they're with a different bank. We've introduced them to you guys, so hopefully they end up coming over and you guys are able to work something out with them. But it's like that bank, they've got not a huge exposure, but maybe 2 million, and their bank's requiring like just all this crazy financial reporting, right? And I just said, well, your bookkeeper, your accountant should be able to put that together for you. What will be even more helpful is within your financials that you get to have like a page 2 that says, hey, you're within these are your covenants. You're green, you're good. Yellow, you're really close to you're there, but you're kind of out of line. Red, you're out, right? Something where you're like are reviewing that, because again, I think and correct me if I'm wrong, I'd be curious what your perspective is. And obviously, like you said, it's very bank specific, right? So this is again where I think it's so important to like make sure you understand who your bank is, how long have they been doing this? Do they plan on being in the space for is this a significant portion of what they're doing, right? Do they have a team? Like you said, you guys have this team of support to support your clients, which I think is amazing. When you're looking at those ratios, have that conversation with your account, see if they can put those in your in your financials, so that you're looking at those at least on a quarterly basis. A lot of banks, like even you said, Craig, you're going to want this, send us your annual company prepared financials. Again, I always look at it this way, as like if you were lending this money, what would you want to see to feel good and nice and sleep well at night, knowing your money was safe, right? Aside from getting regular payments, you probably want to see some financial reporting every once in a while, right? I mean, that's not I don't think like an unrealistic expectation. But the other thing that's interesting is that we are seeing, and we touch on a little bit, the money getting smarter. Unfortunately, we are seeing higher default rates. We are seeing higher percentages of foreclosures and closures, right? Again, when I started in the industry, probably when you did too, was like dentists never default on their loans. Now, again, I'm sure it happened, right? But it just wasn't a thing, right? And now we're seeing it is kind of becoming a thing. Luckily it's still, I think, we were talking at dinner a few weeks ago about this, like, in terms of businesses, it's still one of the safest businesses that a bank could lend to, right? I mean, the default rate's still very, very low, but it's increasing, changing. And I think that's, again, because of that, unfortunately, the banks are needing to kind of tighten some of these restrictions, right? We saw with, with what was the banking, a couple years ago, where it was like deposits became all of a sudden a really big thing for banks, right? Because of Silicon Valley Bank, and now liquidity becoming a really big thing, right? So as you guys are kind of learning, like you said, you're in the space, which is both good. I'm not going to say it's bad, but I think it's good, but also makes you more aware of, oh, this is what a good practice should look like. These are what the numbers should be. This is what profitability should be. This is what a successful practice or venture would look like. So now that we know that, and we've seen enough of these to know that, we also know what a not so great practice looks like, right? And
Right.
which again, I think protects the bank.
Yeah. Well, and to that point, we are very, very skilled. I mean, all of our underwriting managers, this is what they do day in and day out. They don't do automotive shops or strip malls. They do practice finance. They do dental. So we are very skilled at being able to see those red flags initially. And you know what? We dig into it. We just don't say, oh, there's a red flag, stop. Use an example. I had a startup doctor come to me a couple months ago with very low liquidity, but he was able to prove where it went, right? So he paid off about $400,000 in student loan debt in a 2-year period.
Wow.
And we had a conversation about that. But great, he wants to be debt free. Excellent. But in certain situations, I'm able to take a red flag with underwriting and say, hey, this was a discretionary use of funds. The doctor, you could see exactly where they put the money. Now, where we run into issues is if we can't see where they put the money, or it just looks like a lifestyle adjustment. And I'll tell you, those red flags, if there's usually one, you could try to work around it with different strengths of the deal. But once you start putting up additional red flags, that's where banks start getting a little nervous.
Yeah.
Yeah.
Well, and I think as you're saying that too, I'm like, just again, if you're listening to this, disclose everything, right? I mean, you're not going to hide anything from the bank. They eventually are going to pull your credit. They're going to go do a lien search. They're going to, right? You're going to read the leases. You're going to read this asset purchase agreement. I mean, you're going to do your diligence again. I said, money's getting smarter, right? You know now what to look for, right? And so we tell clients all the time, like, listen, we have a pretty comprehensive, robust view of our clients' financial situation, but it doesn't mean that there's things that maybe they haven't even disclosed to us, or like, oh, I got divorced. And like, we see this a lot of time with divorce, like where you're like, I got divorced, my wife got the home, but my name's still on the home. It's like, well, that's going to show up as a lien against you, even though, right? I mean, there's sometimes things like that just never maybe got cleaned up. But again, if that's the case and you disclose that to up front, right? You might say, hey, we're going to need to get that cleaned up. Like, or you might say, okay, as long as we know, or you can show us your divorce decree that you're not, like, whatever, right? But now you've given time. Number one, you've disclosed it. Number two, you've given now time as underwriting's working through, you're working the file, you can be fixing those things, as opposed to, hey, we're supposed to close on Friday, it's Tuesday, and we're drawing up loan docs. We're going to do one more credit pool. We're like, hey, what's this new $1 million loan you've got on this condo in South Carolina, right? Like, that's going to be a problem, right? So I think that's something I would say, again, one of the things reason we love working with you guys is because you do work with a lot of our clients and get a lot more approved and through than not. One of the things I think that is almost like a guaranteed deal killer is like you said, one red flag, fine, let's work through that, right? As long as the explanation, it makes sense, right? Great. I think, again, I'm thinking of a client we have in common who had some credit card expenses, right? And it was like, I mean, but we were able to prove they're all business related, not personal. It's like, okay, those are all in the P&L. Okay, we're good. We can kind of check that box, like, not a big deal, right? But disclosing that's when we work through that. But then if one turns into two, turns into three red flags, and then we get through those, and then you're like, okay, we're ready to close, and then it's like, oh wait, what's this house that just popped up on your credit report? Or that's from again, I've seen it all. I'm sure you've seen even more, right? But just make sure you disclose, make sure up front, make sure you're like,
Right.
you're not going to hide anything from the bank. And I think that's really important to kind of remember.
And banks do look at character,
Yeah,
right? Do
for
look at
sure.
character issues. You know, we will look into the licenses of doctors too, and if there's license actions, we look into it. If you didn't report a bankruptcy and we found it, the underwriters can ask why. Why wasn't this stated up front?
Yeah.
So yeah, upfront is the way to go. And Jonathan, I've worked with many of your clients. You know that I do my analysis upfront. Tell Craig everything. I'll tell you what it looks like from a debt service, what hurdles you might have, and I'll give you options. Do you want to move forward with these items that I see? Yeah, but upfront's great. Having that information on hand and being able to clearly communicate with the underwriting and credit teams is paramount.
Awesome. Last question that I have for you, Craig, and then I don't know if there's anything you want to give as far as any kind of parting words or any promos or anything you guys are running. I'm not to put you on the spot. I don't know if you aren't. If you're not, it's okay. Sure, I'd ask. When we're structuring these deals, what we're seeing a lot more, which is a lot more common with these acquisitions, especially at the second, third, fourth, fifth, sixth, 10th practice, is a combination of debt. So hey, it's $1 million practice to get $1 million acquisition purchase price. Let's give you $600,000 in cash and then $400,000 in equity in the DSO or in the group. Right, we're seeing a lot of these kind of combinations. How's the bank look at that? Does the bank like those? You look at that as a way of like the seller participating in some of the risk with them, and then how do they look at that equity as that's obviously got to be on the balance sheet, right? As something that's got to be paid out at some point in time in the future. You guys like those deals? Don't like them? Is it an automatic yes? Is it an automatic no? Is it a leaning towards no? If it's like what just again out of curiosity, just because we're seeing more and more of these types of creative structures with these acquisitions.
It's a double-edged sword. And I'll start with some of the good. Some of the good is now you have additional owner practitioners running these practices. And why that's good is because you have continuity of operations, right? So if somebody goes down, if something happens, you have more owners than one to help step in for that. In addition to that, you retain some talent, right? Sometimes that's why you're allowing somebody to buy into your practice, is you want to retain that talent. And we see that. The other side of the sword, what could happen here too, is I'll start with one fact is sometimes you do that too many times. You have this very convoluted ownership structure where you might have 8 to 10 practices with different ownership percentages of different doctors. And what banks are going to want to see is if a doctor owns 20% or more, they're going to want them as personal guarantors. So if you're going out to purchase your 9th practice and you have 8 different doctor practitioner owners, we're going to need a personal guarantee from everybody, and that just increases the risk that somebody has an issue. Somebody has delinquencies or very high lifestyle expenses. But again, double-edged sword. That doesn't happen too often. A lot of times we do see common ownership in a multi-practice, dental offices, and we will see it either way. We will take a look at it and analyze it either way. I can't say one's better than the other. They both have their strengths. They both have their weaknesses.
Yeah. Okay. I was just curious. Like I said, we're seeing more and more of that structure. Well, Craig, I really appreciate you coming on here. It's always a pleasure when we get to spend time together and tap into your wealth of knowledge around this ever-changing space. Put you on the spot. Interest rates. Any thoughts around interest rates? They come in. Everyone thinks they're coming down. People think they're going up. You guys, what are you guys being told internally? Should people plan on them staying where they're at, or what do you think?
I'll say cost of funds is what the banks utilize, right? And the best way to look at where banks are is to take a look at the 10-year treasury. Just go online, take a look at it, see where it's at. We did just see a spike, probably looking at about a 20 basis point increase, but we're still mid fives. Sometimes it depends on the day. This economy is so wild, but we are actually offering a promotion right now. It's called relationship pricing. So if you're willing to do a checking account, merchant services, which is some credit card terminals and a business credit card, we're offering a half a point discount.
Awesome. On
So
the
that
on
could
the
be
interest rate on the loan?
substantial on the entire loan. Yep.
Wow. That's huge. That's really huge. Awesome. Well, that's great. Well, Craig, anything else you want to say as we sign off here?
I would just like to thank you again for having me. I love working with your team. You guys are always so punctual. You have the information on hand. It's a multiplier for how quickly we could get to our service level for our clients, and the quality of information that comes out is amazing. So thank you for you and your team.
That.
Yeah.
No, thank you. I mean, again, big relationship. I'm really big on relationships, and we really enjoy working with you guys and your team. And it's been fun to work with Phil and then you, and get to spend time with you guys at the event is always a good time. And I mean, your Huntington's our go-to number one choice. Again, there's a reason for that, right? Not only your customer service, but also very well-oiled machine of a team and great rates and all around good service. So we appreciate that. Appreciate you guys being partners, are one of our partners, and looking forward to having you guys out here in September. Craig, thanks again for your time, for sharing your expertise and insight into the banking lending world. I think it's an interesting conversation to be revisiting on a regular basis. As you said, it's ever changing. So appreciate you being on here.
Thanks for having me.
You got it. Thanks. Bye, everyone.
Thanks for joining us on Dental Wealth Multiplier. To make sure you don't miss an episode, go ahead and click the subscribe button. You can also visit us at dentalwealthmultiplier.com to get access to the links or materials mentioned in today's podcast. You can also see other episodes and get access to the most recent reports, tools, and information to continue your wealth building journey.